Infosys, the top loser today, down over 11% as we speak after delivering a shocker of a fourth quarter performance where earnings miss estimates on all fronts. The company misses its guidance for FY23 while the management remains uncertain of the outlook going ahead, as a result of which brokerages issue a whole host of downgrades.
In more bad news for the IT sector, Tech Mahindra slumps more than 5% after Citi downgrades the stock to sell, citing challenges across multiple verticals that could hit growth.
Infosys shocker and a big downgrade for Tech Mahindra hit sentiment in the IT space. L&T, Mindtree, Persistent and all other mid-cap IT stocks see cuts of almost up to 8%.
HDFC Bank trades low after its fourth quarter numbers missed street estimates. The operating expenses remain elevated on network expansion, while net interest income growth remains strong.
We do have a bunch of other stocks on our radar as well. Camblin Fine trades higher after promoters launch an open offer. TV18 gains after subsidiary Viacom18 completes a modified strategic partnership with Bodhi Tree and Paramount Global. Meanwhile, GTPL Hathway down 9% after weak fourth quarter numbers.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me always is Mangla Malu. Well, we're having a bit of a manic Monday, so to call it. The Nifty was down close to 250 points just a short while back, but at least from the lows, we have seen some bit of buying. The positive, though, is that in the broader markets, you have still quite a few stocks that are doing very, very well. And one such stock that's done pretty well today is HLE Glasscoat. The stock is up close to around 13%. Remember, that is one of the stocks that has halved from the peak. It was close to around 1,300 rupees on an adjusted basis. And today it's moving higher on very, very large volumes. So we'll try to find out what is the reason for that front. But there are plenty of other big gainers as well from the broader markets, which is a bit of a positive when you have the headline index down 200 points odd. But let's get in our technical expert. We have Shivangi Sarda, who joins us on the show. Hi, Shivangi. Good morning. Thanks so much for joining in. Well, we have come off 50 points from the day's low. 17,575 is the level from where we bounced. How would you trade the index from here on?
Absolutely. Good morning, Nigel and Manglam. Thank you for having me. So we've seen that Nifty has, taken a bit of dent and it is trading weaker than Bank Nifty today. Clear underperformance can be seen over here. Global forces are quite weak, which has, given a little pressure on the index. And we can see that, the bearish candle that has been formed, it's quite a big one. But the good part is that it has taken support near 50 exponential daily average levels. And we can see some sort of support-based buying, but then again follow-up buying is missing. So we would wait for it to hold above 17,650 levels and then take a trade over here. The support could act 17,500 and upside resistance would be around 17,777 levels. So it is expected to hover in this range. Now India VIX has also surged quite a lot today, which is causing some sort of a volatility and swings in the market. On the other hand, if we look at Bank Nifty, it is still holding well at higher zones, and we've seen that it respected its previous day's lows levels as well. So recommending a buy or decline strategy over here in Bank Nifty. Heavyweight banking stocks are holding quite well, which is providing a tailwind to the index. And, we could see levels of around, its intraday high levels over here today, like 42,600 levels over here, with a support near 41,750 levels.
All right, take your point there. In fact, a couple of things that really stand out today. One is that the low on the Nifty today is still above the 200-day moving average. So that is, an important mark of support to watch out for. And secondly, despite the weakness that we're seeing in HDFC Bank, the Nifty Bank is still holding above the 100-day moving average that it captured on Thursday. So that is a positive. 41,700 is where the Nifty Bank's 100-day moving average is placed right now. A couple of mid-caps doing extremely well. We have, Precision Camshafts up around 11%. Ethos continues to do well. Remember, last week it had given its fourth quarter update, so up around 7% And then you have Raymond, which is higher by about 4.5% So we are seeing some action in the broader markets. The mid-cap index outperforming. We have, a bunch of them in the sub-FNO segment, cash segment, doing extremely well. Shivangi, what individual stocks do you have on your radar today for us?
On my radar today, first is the cement sector, which is Ultratech Cement. We've seen that the stock has been continuously making higher highs from the last 6 months and 6 weeks, which indicates that the base is gradually shifting higher. And we've seen gradual buying interest over here with longs being built up in this series so far. And, the open interest addition over here, the gradual increase is indicating that the buying can be seen at a very good pace. So recommending a buy here with a target of around 8,090 levels and a stop near 7625. My second pick would be Chola Finance. We've seen that this stock, of course, having its tailwind from the entire sector, and it is making a pole and flag pattern formation on daily frame and a breakout at those levels. And in this series so far, we've seen 21% open interest addition over here with a 10% price rise. So overall, the stock is quite positive with the good buying interest and momentum built over here. Now, put call ratio is improving, which indicates that the put writers are creating a base over here in this stock. So recommending a buy here with a target near 865 levels and a stop near 815.
Okay, all right, Shimangi, thanks so much for stopping by, giving us your view. We look forward to chatting up with you rather soon. Well, it's a good time then to shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Nandesh Shah of moneycontrol.com joins us to talk about a stock that is tracking very closely. Nandesh, what do you have for us this time around?
Today's ideas for profit is Godrej Consumer Products. GCPL ranks amongst the largest household insecticide, air care and hair care players in emerging markets like India, Indonesia, Africa, and second largest player in soaps in India. GCPL is likely to report double-digit growth in INR terms on a consolidated basis for the March 23 quarter on the back of mid-single-digit volume growth. India business, which contributes nearly 55% to consolidated revenues, is likely to witness broad-based double-digit growth for the March 23 quarter as compared to 9% growth in the March 22 quarter. Domestic branded business registered volume and value growth in teens for March 23 quarter as compared to 8% value growth in March 22. Indonesia has started to witness gradual recovery in performance, and in March 23 quarter, they expect mid-single-digit constant currency growth as compared to 16% decline in the March 22 quarter. African markets are likely to witness mid-single-digit growth in constant currency for the March quarter as compared to 14% growth in March 22. On the back of correction in palm oil prices, gross margins are likely to witness improvement. Despite higher investment in advertisement, EBITDA growth is likely to be in double digit for the March 23 quarter. Based on our projections, GCPL is trading at 45 times FY24 earnings, and we remain positive on it.
All right, Nandesh, thanks a lot for that. With that, we'll step to a short break, come back, get you more on the individual stocks and overall markets. The Nifty now down 200 points, though it is well off the lows of the morning. Still sitting with a big cut, largely because of Infosys.
Welcome back. Well, a few stocks are actually doing very, very well. Last week, we saw some massive traded volumes on NBCC. And today as well, volumes have picked up, and that stock is spiked to the high point of the day. So from trading in the red terrain, that's turned around. The other turnaround factor has been AU Small Finance. It was up close to around 17% because the current MD and CEO, he's got an extension for the next 3 years. The street views this positively because, that was a bit of an overhang on the stock. So after rallying 17%, today it pulled back close to 2%. But from those lows, it's up close to around 3%. So good going out there. And Info Edge, that's the other one in there. You have a couple of these big IT majors who have reported disappointing numbers. But one thing that's constant that they're talking about in common is that attrition could go down from here on. We also are talking a bit of a slowdown in the economy on the whole. And if attrition goes down, then maybe it'll be a bit of a negative for a stock like Info Edge. At least that's what some part of the street believes. So let's see how that plays out. But for the time being, the stock was down 5%. It's recovered 1.5% from the low point of the day. But Infosys, that's the top Nifty loser today after delivering shocking set of numbers in the fourth quarter. Constant currency revenue growth fell by close to around 3% compared to estimates of 0.4%, while margins too contracted. The stock is the top loser on the Nifty today, and the management remains uncertain about the outlook going ahead. Ritu Singh caught up with the CEO of Infosys, Mr. Salil Parekh, and spoke to him regarding weak revenue growth and the miss on the guidance. Let's hear out what he had to tell her.
For the quarter Q4, what we saw is during the quarter, there were some clients where we saw ramp downs, and then there were some areas where we saw one-time situations. As Nilanjan had shared, the bulk of the impact in the quarter was from the ramp downs that we saw during the quarter. In terms of the guidance, the way we've constructed the guidance is based on what is the large deal and overall wins we've had in the year and also in the quarter. And then a lot of our work, which is multi-year work, that carries through. So based on that, we've also expanded instead of a 2-point guidance, which we normally give, we've done for a 3-point guidance, more with a view that the environment is uncertain given what we saw in Q4. Having said that, we have an extremely strong large deal pipeline. We have some deals which are mega deals in the pipeline. We know that there are many deals on cost. We are benefiting from some consolidation discussions on efficiency. So we anticipate that as the year goes, we will see what happens to those deals, and then we'll come back and look at the situation. Of course, the environment is also uncertain.
Sure.
So we have to keep both things in mind.
You know, I'll come back to the deals because there's a lot of conversation around that as well. But first, when you say ramp downs, specifically where has that been? And have there also been cancellations of orders, if any? And, why are you so confident it's only a one-time thing when you say the environment is so uncertain?
So there are two aspects to it. So one on the ramp downs, there have been with some clients in the telco sector, in the high-tech sector, in retail, and in financial services, in mortgages, asset management, and investment banking. So those ramp downs, we saw some stabilization in March, but the demand environment is uncertain. So we will see how that plays out as we go ahead. And that's the way we see that.
You continue to tell us that you have a very strong, large deal pipeline. Why is it that is not immediately translating into revenues? Is it because clients are taking longer to make decisions? Are projects not getting started on time? Why is it that it's not translating into better revenue growth?
So there, as we've said in the past with large deals, the timing is not like a predictable thing when they come in a year or it's going to come every quarter or something. But over 1 or 2 or 3 year periods, you see this thing shows more stability. There is slowing in decision making for large deals. So the time, let's say discussion or deal is in a pipeline becomes a little bit longer. Has been, we've seen the data. But when the decision is made, it starts right away, and that translates.
On the margins as well, the street was expecting you to, reverse it to what we'd seen a year ago to 21 to 23%, because last year was an exceptional year. There were higher wage bills, but hiring is not happening at the same pace. You're not aggressively making lateral hires. Why is it that you chose to stick to a lower band? And what are the levers for expanding this?
So there. As you saw, we closed the year at 21%.
Lower end of the guidance.
Which was, let's say, a strong operating margin with all the investments we've made. We have low utilization in Q4. We will continue to make sure that those individuals start to get onto projects as the year progresses. The levers that we have today, several of them we shared earlier, whether we look at what is the mix on our projects, whether we look at the work on-site and offshore, whether we look at subcontractors, travel, office consolidations, pricing, and then automation. So we have a large number of levers, and we've expanded the attention to this program during the quarter as well, and we see that will give us a benefit over the next future periods to further support our margin expansion.
Well, that really is the stock of the day, and it is the talk of the town. At least it will be for the next couple of weeks as well as we speak. Brokerages HDFC Securities and Nirmal Bang have opposing views on the prospects of Infosys going ahead. Join us as we decode the road ahead for the company in our bull versus bear segment at 11 a.m. today. What should you be doing about Infosys? The stock down 11%, but more importantly, about the IT pack itself. Two opposing views and divergence of views makes the market, so this is a conversation you do not want to miss. With that, we'll slip into a short break, but on the other side, we will continue to track the markets. Stay tuned. Well, what an exciting market this is. I say it exciting because, not because of the way Infosys is falling, but the way Nifty Bank has recovered, and this despite the weakness that we're seeing in HDFC Bank. In fact, Kotak Mahindra Bank, that's the one that should come up for you. It has recovered about 4.5%, 5% from the lows, currently at the high point of trade, and that's supporting the Nifty Bank. Apart from that, we've seen, even if it's lower, HDFC Bank has recovered from the lows. In fact, it's now down about 1.5%. At one point, it was down by over 2%. So that's another counter which is supporting the Nifty Bank from falling further. And just the Nifty itself, is being supported by not just the resilience in Kotak Mahindra Bank and others. Watch out for the FMCG pack, ITC. It's hit the 400 mark, and that's the first time the stock has hit that milestone ever. It's a fresh record high for ITC, and that's the second highest contributor on the Nifty. So if you just take a look at the way the Nifty is positioned right now, 159 points lower, 127 points taken off Infosys, and 23 points taken off HDFC Bank. X of that, the Nifty fairly and well in the green. ITC, the intraday chart, comes up for you right now. It is at 400.7. Nigel, for all the memes on ITC over the last couple of years, etc., what a start this has been at the high point. Smoking hot. That's the only pun that comes by.
I'll tell you what, if you can get the ITC chart for the last 1 year with the Nifty up, that will tell you the kind of outperformance you see in Mangala. For all the memes, people are saying that, that one's stuck, it's not moved in many, many years. Well, the last 1 year or so, what a move the stock has been. And apparently it still it's not very, very expensive still. You'll be the best judge on that, but it still has those triggers. The triggers haven't yet played out. So either the run-up is in anticipation, or we'll see how this plays out. So I think if we pull up both the ITC as well as the Nifty chart, 1 year chart, will be a superb indication of the kind of outperformance we have seen from ITC in the last 1 year.
50% on ITC, and there you have it. That's the chart. Nifty
Brilliant.
Up 1% in the last 12 months. The ITC stock up 48%. Superb work done by a director out there to bring both of them and to give you that picture. But previously, remember, the last 7 or 8 years, ITC has been a significant underperformer. So it's just come by and gone ahead and knocked the ball out of the park. But HDFC Bank is the stock that we're talking about. Lower after reporting its fourth quarter results. Abhishek joins in with the highlights. Abhishek.
Well, the bank is building on for future traction, so the cost is being incurred right now. However, asset quality and the quality of the portfolio remains impeccable. So what has worked in this quarter is that despite rising cost of funds, the net interest margin has remained stable, and NII growth on a YOY basis is pretty strong at 23-24%. The slippage ratio of 1.2% is perhaps the lowest in last 6 quarters and second lowest in last 31 quarters. So that helps the asset quality remaining stable, with gross NPA ratio being the lowest in last 9 quarters. ROA remains robust, that is return on asset. It remains at 2.1%, with PCR or provision coverage ratio being the best in last 9 quarters, above 75%. So RWA to advances ratio is at the lowest in 4 quarters and the second lowest in 17 quarters or more, which suggests that the book is being built in a secured manner with lower risk. Restructured book at mere 0.3% is the lowest in last 10 quarters, and HDB Financial has reported strong numbers. The PAT is the highest quarterly PAT that they have seen, with asset quality being the best in last 9 quarters. What has not worked in the result is the operating efficiency, given the fact that OPEX remains elevated due to the branch expansion that they have taken. So the cost to income ratio is at 42%, perhaps the highest that you are seeing in last 25 quarters. And CASA growth rate, or the low cost deposit growth rate, is the lowest in last 3 quarters. For third quarter in a row, you are seeing CASA growth being below the overall deposit growth. This is a trend seen across industry peers as well. Corporate loan growth YOY is below the overall loan growth, and in terms of PNL, NII and PAT is below our poll. Back to you.
All right, thanks a lot for that, Abhishek. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.